I have a client asking for some explanation about severance pay system managed by third party. So I make some summary of my explanation to my client. Corporate retirement pension system overview. This system allows companies to deposit and manage employees' severance benefit through external financial institutions rather than keeping them internally, and pay them as a lump sum or annuity upon retirement. It was introduced to enhance both the security of severance payments receipt and retirement preparedness for employees. Types of retirement pension plan. Normally we think about two types of retirement pension, which is deposited to the outside financial institutions. The first one is DB, the other DC. As I mentioned later, companies prefer DC. So when my client asks me what to choose, I say that the company is beneficial to take DC instead of DB. DB is defined benefit plan. Defined benefit plan. Benefit plan. This is defined contribution plan. In DB, benefit is defined, and DC, contribution is defined. The benefit amount at retirement is predetermined. This means the employee will receive the same amount at the retirement, same unchanged amount. Now, the formula is average wage of the last 3 months multiplied by years of service. The employer is responsible for investment management, and this pension plan, the employer is responsible for the investment of this pension fund. Even if investments perform poorly, employees' benefit does not change. So in employee's case, the stability is determined. But if the employee himself or herself want to make some investment of their own, that it cannot be done because the responsibility is rely on to the employer. In DC plan, defined contribution, the company contributes a fixed annual amount to the employee's individual account. And the employee is responsible for managing the investment. In this case, employer is responsible for investment, the employee is responsible for the investment. The final benefit amount varies depending on investment performance. So fluctuates based on investment results. Benefit of retirement pension system. Number one is secure custody. Number one is secure. Funds are held with insurance companies, banks, or security firms unaffected by company bankruptcy. Number two is investment earnings. Funds can be invested in deposit, bonds, or mutual funds to generate additional returns. So this money doesn't sleep. This money will be contributed to the investment of some stocks, bonds, or coins, or ETF, and so on, or bond. Tax benefit. Contribution to DC are fully deductible in computing corporation income tax. This is one of the benefit of DC. defined contribution. Pension-based payment option. Employees can choose to receive pension payment instead of a lump sum, improving retirement income stability. The employee can choose to receive it lump sum or in annuity. Key points employees should know. Number one, choice between DB and DC. Between DB and DC. Basically, the choice is up to the employee. When employee prioritize stability and DB is okay, and invest actively. The employee want to invest actively of their own, then DC is chosen. IRP is essential. To defer taxation, severance pay must be transferred to an IRP account upon leaving the company. Receiving it as a lump sum immediately by cash result in tax liability. So when the employee actually retire, the employee will receive the money from the financial institutions, and then we have IRP account in Korea. So if the employee take the money, we deposit the money into IRP account, then the taxation will be deferred. Track and manage investment performance. In the case of DC, active management can significantly impact the final retirement benefits. In DB, employer will invest. In DC, employee will invest. So the change the comparison table of the two, DB and DC. Calculation method. Average wage, as I mentioned, average wage multiplied by years of service. In this case, employee contribution every year plus the investment gain or loss. Gain or loss fluctuation. Number two, investment responsibility lies to employer. Investment responsibility lies to employee. Benefit variability, no change except wage fluctuation. And benefit variability change based on investment performance. The change. Impact of investment return. Employee unaffected even if returns are low. Final benefit varies depending on personal investment outcome. Advantageous when wages increase steadily or employer investment ability is weak. Wage growth is low and or employee actively invests. Best for employees who value stability. Employee capable of managing asset herself. The risk, investment risk, employer bears the shortfall. Poor investment will reduce the benefit of employee. Predictability of retirement benefit high because the amount is stable. Predictability is low because depending on the receipt will depend on the performance. Investment choice, employer decide. Employer. And investment choice, employee selects deposit, bond, fund. Impact of salary growth, higher salary, near retirement, increased benefit. Less impact. Summary in one sentence. DB plan is stability, predictability, employer responsibility. DC plan equal higher return potential, investment freedom, employee responsibility. So now we're talking about the investment system overview. Legal framework. Under the Employee Retirement Benefit Security Act, every employer in Korea must operate at least one of the two following systems. One is in-house reserve. Number two, DB. Number three, DC. Minimum legal requirements apply to employee with one or more years of continuous service. So when the employee works less than a year, basically the employee has no power to get the severance allowance. Minimum statutory benefit is 30 days of average wage per year of service. So roughly 1 month per 1 year. Compensation of system types. The system lump sum is, this means the reserve, when in the case of reserve in-house, the employer does not pre-fund the severance amount. Instead, it is carried as a liability on the balance sheet and paid in a lump sum at retirement. If the company becomes insolvent, the severance payment may be at risk. Employee rely on the employer's financial stability. So Korea suffered 1997 IMF bailout fund. So in that case, many companies bankrupt go south, and then in that case, many employees cannot receive the retirement allowance. Because the fund is set aside in-house. So after we get that the anus experience, the government adopted the DB and DC and strongly recommend the company to take DB or DC. Retirement pension plan managed by external financial statement. One is DB plan. As I mentioned, the level of retirement benefit is predetermined. The employer contributes annually to an external institution and may need to make additional contribution depending on funding and investment performance. Employees receive the promised amount as a lump sum or pension at retirement. In the case of DC, defined contribution, only the employer contribution is predetermined. The employee selects investment products. Employee herself select investment products like deposit, bond, fund, etc. The final benefit amount depends on investment performance done by employee. Pros and cons of adopting an externally managed retirement pension system. From the employer's perspective and from the employee's perspective. Compared to reserve in-house, the DB or DC, the outside third-party deposit has what kind of pros and cons? From the employer's perspective, advantage. employer's side and employee's side. Advantage and disadvantage. Advantage, disadvantage. Advantage is what advantage? The advantage when take the third party rather than reserve. Liability transferred. Retirement obligation become externally managed, improving financial reporting clarity. Number 2, pension assets are protected even if the company becomes insolvent. Positive for ESG and governance compliance. Number 3, useful where global headquarters require formal funded pension system. Number 4 is tax benefit. In case of DC, full contribution amount is deductible as an expense, DC. Consideration or disadvantage. Mandatory contribution payments may create short-term cash flow pressure. Company should deposit the money annually so it can raise temporary shortfall of the company. Cash shortfall. Administrative and management fees apply. The financial institutions do not work free. They charge fee every year. Under a DB model, poor investment performance may require additional contribution. The responsibility lies to employer. From the employee's performance perspective, advantage is retirement benefit is protected regardless of employer insolvency. Number 2, potential investment returns, particularly in DC plan. Favorable tax treatment, including preferential tax rates for pension withdrawals when apply IRP. Consideration or disadvantages: withdrawal are restricted except for limited qualifying reasons. Home purchase, long-term care, blah blah. Okay, now we compared between the two, the reserve in-house and reserve in third party. Now it's time for comparing DB and DC. Practical checkpoint, checklist for converting from lump sum severance to a pension system. So what the company should do to change from the reserve in-house to third-party reserve financial institution. Number 1, determine between DB and DC. Now, company decided to change its severance system from the reserve in-house to third-party accumulation. So, in this case, number 1 is determine which system the company will take between DB and DC. In most cases, company choose the DC plan. As I mentioned, in the company side perspective, DC is more favorable. There are 3 reasons. Number 1 is, under DC plan, full contribution amount is tax deductible, but DB is not tax deductible. Number 2, and the system is simple. Number 3, with a DC plan, severance benefits are calculated and settled annually, finish. This means that even if an employee's salary increases as the year passes by, it does not retroactively change prior year contribution amounts. So in DC case, when the year 24, 25, in 25 year end, if company accumulates the money to the financial institution, they will settle everything. There is no need in the 25, the employee salary increase, but this will affect only for the year 25. This does not affect the year 24. and DB contrary. In contrast, under DB plan, the formula is year of service multiplied by average salary of the last 3 months. So, if employee salary increase, the retirement benefit amount for all past year also increase. In DB case, the increase of employee salary will be affected retroactively. But in DC, the increase of employee salary affect only that corresponding year. And also the company should think about the change. Number 2 is employee consent and amendment of internal rules. The change constitutes a modification of key employment conditions, so this should be accepted by the employee. Requires majority employee representative approval, and should update the work rules and filing with the Minister of Labor. This change should be filed with the Ministry of Labor. Number 3, select financial providers. Who will take care of the third-party severance? Which financial institution the company will take? The bank, security company, insurance company. So most of the major financial institutions deal with this retirement pension scheme, DB or DC. So the company should choose what financial institution they want to use. Typically, evaluate 2 to 3 institutions based on investment product lineup, fee structure, and training and ongoing account management support. But the fee is very important. Fee. Charge to the bank or security company or insurance company, which will take care of the third-party severance allowance. This is very important. Fee is very important because it applies to the full amount previously contributed and currently held cumulatively by the financial institution. Therefore, the fee is relatively small in the beginning stage, but it increases over time as it is applied cumulatively to the growing balance. This is very important. In year first year, second year, third year, fourth year, and on and on. First year, the employee salary is only that year. It's small. And second year, the accumulation is like this. Third year, like this. Fourth year, bigger. So as year pass by, the balance reserved, deposited into the financial institutions grow bigger and bigger. The fee rate, for instance, 0.7%. This fee rate will be applied to the whole body. So the amount will increase every year. So the compare the fee between the financial institutions is very important. Thank you for listening my explanation on the severance pay system managed by third party. Thank you very much.